We'll welcome in our team from Charles Schwab. Joining us in studio today, we have Joe Mazzola, the head trading derivative strategist at Charles Schwab. Joe, thanks for being with us today. You know, as I look at the board, we are now green across the board on all four indexes. You know, just what are your thoughts on the session on the whole?
Well, when I wrote my notes, I basically said it's a boring day, nothing's going on, a dull August day, and you know we're rallying into the close. And I do want to correct that to a certain extent because look at the Russell. I mean, I know your last guest was talking about it, but 4% in 2 days. And so, how much of that is contingent upon, the fact that markets are pricing in a 98% rate cut? I think the comments from Bessent, Secretary Bessent, helped this morning. Whether or not a 150 basis point cut should be priced in, I don't know, but it gave a little bit of rocket fuel to some of the small caps. And I think what you have to understand about the Russell in particular, and the reason maybe that it is benefiting so much today, is a lot of those companies within the Russell 2000 are what we kind of call the zombie companies, right? You know, about 40% of them. And these are companies that aren't generating enough revenue to cover their debts. And so they will benefit from a cut because of the fact that they have so much debt on the books.
And I want to talk about, too, the yields. You know, we saw the yields drop on that news from Bessent. And I just refreshed the FedWatch tool again. It's now 100% priced in September at the highest that we've seen. That's interesting to me. You know, it seems like Treasuries are not pricing in risk as much as we have historically seen in the past. Are Treasuries also becoming somewhat desensitized?
If you put 100% probability on something, that really doesn't give a lot of movement to the other side, does it? I mean, yeah, I would agree. I would say that Treasuries are looking at what they're seeing in the economy right now, where there is a slowdown. You know, all you have to do is go back to the jobs data. We've seen that it's not just in the jobs, but we've seen other factors as well. Some of the ISM data that came out about a week and a half ago, and they're saying, okay, look, everything has been served up, the way that you want, Chairman Powell, right? You've got a slowing, job market. You've got a little bit of slowdown in what we're seeing with the economic indicators, and the CPI data this week. And this is what's interesting to me. The CPI data, yes, it came in line with what the expectations were, but you dig a little bit lower into that core number, and maybe that core number wasn't as rosy as the markets are pricing it to be. And I think that that's kind of what you're getting at, is that, hey, everything is priced for perfection right now. Sometimes that sets up for a little bit of tail risk.
So let's talk about that CPI print, because I think when it didn't come in as hot as expected, we saw this sort of celebration factor. It's not as bad as it could be. But you're talking about, when we're looking under the surface, and you were one of the first people to say in the employment picture before we got that bad jobs report, that under the surface, there were major cracks. You were one of my first guests to say it, and sure enough, you were right, and we saw those downward revisions. So when you were reading through
I'm going to mark that one down.
You were, and you heard it here. I said it. It came right out of my mouth. You were one of the first people to say there was a problem there, and then we saw the problem with the revisions. With the CPI print, what under the surface, that is not being properly acknowledged for you?
Yeah, I think there's a couple of things. I think that goods maybe aren't reflecting the tariffs just yet, right? I think that that's something that we still need to pay attention to. And I think that, if you look at the CPI and you kind of strip out some of the energy data and things like that have pulled back, and you just look at the core, I mean, there is bubbling inflation below the surface. 2.7% on an annualized basis is not what the Fed is looking for. I think what is important, though, is to pay attention to the fact that, I look at it as a derivative, right? That rate of change has really kind of slowly started to creep back up, and we just need to kind of keep an eye on the data as we go forward. I think that's what Chairman Powell would love to be able to do, is just have more time. But I think there's probably a little bit too much pressure coming not only from Washington, but really from his own group of Fed governors as well too. We've seen that with talk with Weller. We've seen that with talk with Bowman. In the markets at this point, I mean, when the markets are pricing in 100% rate cut, that's telling him that, he doesn't want to go against the markets and it's time to move.
Yeah, and as far as the PPI number coming out tomorrow, what are you looking for there, specifically, I guess, under the surface?
Yeah. I would kind of go back to maybe some of the things that we saw in the ISM recently, and then that would be that prices paid are starting to ratchet back up. You're also starting to see employment numbers kind of move down a little bit in terms of new hiring. And then you're seeing new orders kind of move down a little bit in terms of new hiring. So it's that crossroads of our businesses now starting to pull back a little bit outside of the AI, right? I think AI is its own kind of separate animal, but the rest of the business community, manufacturing, so on and so forth, I think starting to pull back a little bit, knowing that the prices that they're paying are going up, and we might see that bleed into the PPI bit.
And last question, I know you're always watching market breadth. How is it looking this week?
So breadth has come back. It's not a screaming buy. It's not something where I would say, we're up at the 70-75% level where you feel like there's a lot of participants. This week, yes, we've started to see a little bit of bump. I think one of the keys, though, is this, and my colleague Liz Ann, talked about this earlier in the week. It's the idea that only about 24 to 25% of the S&P 500 companies are trading above the S&P 500. So or are beating the S&P 500 is a better way to put it. So that's something that says that it's still a very narrow leadership in terms of who's beating the S&P 500, and it points to the fact that it's still a stock picker's game.
Well, Joe, thanks for being with us in studio today. As always, that's Joe Mazzola from Charles Schwab.